I looked at the price of gold 10 minutes ago, and it was up $10. Now it's up $30. So it's regained half of the $60 loss already. So we're back above 2,600 at 2,612, but we were down below 2,600 when trading closed. But you know what's amazing? The gold stocks, again, got absolutely hammered today, right? Barrick Gold was down 4.5%. I'm giving you the big ones. Newmont Mining was down 5.5%. This is how ridiculous it is. So gold, before this $30 rally, because I looked at the numbers before this rally. So before this $30 rally that we're having right now, gold was down about 7% from its peak, about $200. That's it. I mean, right now it's down less than $200 from the peak, but that was 7%. If you look at Newmont Mining and Barrick Gold, Barrick Gold is down 13% year to date. 13%. Newmont is down 8%. Gold is up 25%. I've never seen a year like this. 25% increase in the price of gold. The markets had already adjusted that down to maybe 2 to 3. So one of them they kind of took off the table. So people were expecting a hawkish cut today, in that the Fed was going to cut rates, but simultaneously indicate that it wasn't going to cut as much as it had thought before. But I guess the markets hadn't fully priced in or considered what that means, because this whole stock market rally has been predicated really on lower rates. And the idea that this new easing cycle is going to propel the market higher, just like prior easing cycles. And I've known that there was going to be a lot of bumps on this road, because I knew that the Fed was not making the progress on inflation that it had believed, or that it was claimed that it was having. And I think this was reality setting in when Powell talked about how inflation had picked up, how inflation was higher than the Fed had hoped or had anticipated, that it's taking longer to get inflation down to 2%. In fact, in the Q&A, that he thinks it may take 1 or maybe 2 more years before inflation goes down to 2%. Now, I don't think it's going down to 2% at all in 2 years. So it's going to be a long wait. But if the Fed is going to have to wait 2 years to get inflation back down to 2%, well, it's going to have to be higher for longer than the markets expected. In fact, Powell indicated that the neutral rate, the rate that the Federal Reserve believes is neutral for the economy, not stimulative, but not restrictive. They notched that up from, maybe 2.8, 2.9% to 3%. And so that also means that there's fewer cuts necessary, maybe one less cut, to get down to where the Fed considers policy to be neutral. Now, the Fed did say that they still think they're well into restrictive territory. They lowered interest rates now down to, 4.25, 4.5. So we're now a full 100 basis points lower than the peak. Although, despite this 100 basis point rate cut, the yield on the 10-year Treasury, which closed above 4.5 today, is now better than 80 basis points higher than it was when the Fed started to cut. So the Fed went down 100, but the market went up 80 on the 10-year, and even a little bit more on the 30-year. This hasn't happened in recent times, where the Fed has been cutting and the market has been moving in the other direction. And this shows that the markets are not believing the Fed to a degree. They're concerned about the growing deficits. In fact, they have this continuing resolution that is working its way through Congress now to keep the lights on, and that includes $110 billion of new spending, in addition to all the other spending, an extra $110 billion. Also, they threw in a raise. I guess that Congress is upset they haven't gotten a raise in the last 10 years. So they slipped a pay hike for themselves into this continuing resolution. But that alone adds another $110 billion to the debt over the next year, in addition to everything else that's adding. They're talking about the DOGE commission to cut spending. They're already increasing it beyond where it already was. And in fact, the House of Representatives passed this Social Security Fairness Act. Who's going to be against Social Security fairness? But what it does is it increases benefit to civil service workers who are getting less benefits. Now this is going to change that, so they get full benefits. That costs an extra $20 billion a year. Just throw that onto the pile. And of course, if they estimate $20 billion a year, it's probably going to cost a lot more than that. But these guys are still adding on new government spending as deficits are exploding out of control. So the bond market is concerned about this. Now, I think it would be a lot worse for the bond market if the dollar was falling, but it's not. The dollar surged today to a new two-year high, dollar index above 108.
The markets had already adjusted expectations for a Federal Reserve rate cut down to 2 or 3 cuts, even before the latest announcements. It seems one was quietly taken off the table. What followed was a scenario that many had not fully anticipated, a hawkish cut. The Fed cut rates but signaled they wouldn't cut as much as previously projected, sending shockwaves through the market. This disruption reveals just how precarious the current financial system has become, especially when tied to the Federal Reserve's actions. The entire stock market rally of late has been based on the idea that lower rates would fuel another round of growth, just like the prior easing cycles. Yet, seasoned analysts like Peter Schiff have long predicted that this time would be different. The inflation battle, despite the Fed's best efforts, is far from over. When Fed Chair Jerome Powell acknowledged that inflation had picked up and was now higher than anticipated, it became clear that bringing inflation back to 2% might take years, possibly even longer. Schiff has boldly stated that we may never return to 2% inflation. This sobering reality underscores how deeply inflation has become entrenched in the economy. If inflation persists, interest rates will need to remain higher for longer than markets had hoped. Powell even nudged the neutral rate, the theoretical rate that neither stimulates nor restrains economic growth, up to 3%, a signal that fewer rate cuts will be needed. This is no small change. It redefines the landscape of borrowing, investment, and economic growth. The Fed has already cut rates by 100 basis points, bringing them to around 4.25 to 4.5%. Yet paradoxically, the yield on the 10-year Treasury has risen by over 80 basis points since the Fed began its cuts. For the first time in recent history, the bond market is moving in the opposite direction of the Fed's policy, reflecting mounting skepticism about the central bank's ability to steer the economy effectively. Schiff has often described this phenomenon as the bond market calling the Fed's bluff. This divergence is particularly concerning given the sheer scale of the U.S. debt. The national debt, currently at nearly $36 trillion, continues to balloon as Congress approves additional spending with no plan for fiscal discipline. For example, a recent continuing resolution included $110 billion in new spending, alongside an absurd congressional pay raise. Add to that the Social Security Fairness Act, which increases benefits for civil service workers at an estimated cost of $20 billion annually, and it's clear that deficit spending is out of control. Markets are rightly concerned. Rising yields mean higher borrowing costs, not just for the government, but also for households and businesses. Mortgages, car loans, and credit card rates all rise in tandem with Treasury yields, further straining the average consumer. Amid this turmoil, the U.S. dollar surged to a new two-year high, with the dollar index climbing above 108. The euro, meanwhile, slid below 1.04, reflecting global confidence in the dollar, or perhaps a lack of better alternatives. Schiff, however, views this dollar strength as deceptive. It's less a sign of true economic health and more a reflection of temporary haven-seeking behavior in a world fraught with uncertainty. Gold, often considered the ultimate hedge against currency devaluation, initially dropped about $60 during the recent market turbulence, but quickly rebounded, gaining back half its losses in just a few hours. This resilience demonstrates the underlying strength of gold as an asset class. Despite volatile trading sessions, gold remains up around 25% for the year, an extraordinary performance in any market. Here's where the paradox becomes even more striking. While gold prices have climbed, gold mining stocks have struggled. Companies like Barrick Gold and Newmont Mining have seen their shares plummet by over 30% from their peaks, even as gold has surged. Schiff highlights this as a glaring example of market inefficiency and misplaced sentiment. These mining companies are trading at bargain basement valuations with price-to-earnings ratios below 12, despite operating in an environment of rising gold prices. This disconnect underscores the extreme pessimism that still pervades the market when it comes to gold. Many investors remain enamored with speculative assets like tech stocks and cryptocurrencies, ignoring the steady long-term performance of gold. Schiff often warns that such misplaced optimism in overvalued sectors will eventually give way to a broader recognition of gold's enduring value.
The euro, I think, is it down to 103? Let me check where it is. The euro is trading at just under 104. So 103 and 3/4. It closed, it's up a little bit in the evening. It was at 103 and a half, but dollar index above 108. So the dollar is soaring. It's the only thing that was up today was the dollar. Everything else, the stock market, the bond market, the Russell 2000 was down better than 4% on the day. And, the Russell 2000 is now down 1% since Trump was elected. A couple of weeks ago, it was up 9%. So we've had a 10% decline, now a full-blown correction in the Russell 2000. The QQQ was down, that's the NASDAQ 100, was down 3.6 today after hitting a record yesterday. In fact, several NASDAQ stocks had some pretty big reversals today where they hit new highs and then they got clobbered later in the day after the rate hike. Everything was down except the dollar. Gold was down about $60 an ounce today. It's up about $10. Now it's up $30. I don't know. So now it's back above 2,600. It's just regained. I don't know what just happened. I looked at the price of gold 10 minutes ago and it was up $10. Now it's up $30. So it's regained half of the $60 loss already. So we're back above 2,600 at 2,612, but we were down below 2,600 when trading closed. But what's amazing? The gold stocks, again, got absolutely hammered today, right? Barrick Gold was down 4.5%. I'm giving you the big ones. Newmont Mining was down 5.5%. This is how ridiculous it is. So gold, before this $30 rally, because I looked at the numbers before this rally. So before this $30 rally that we're having right now, gold was down about 7% from its peak, about $200. That's it. I mean, right now it's down less than $200 from the peak, but that was 7%. If you look at Newmont Mining and Barrick Gold, Barrick Gold is down 13% year to date. 13%. Newmont is down 8%. Gold is up 25%. I've never seen a year like this. 25% increase in the price of gold. Yeah, it's not the 30% that it was, earlier, but 25% up is a hell of a year. One of the best years for gold. And these stocks are down. Now, it wasn't too long ago, before Trump was elected, the gold stocks were up more than gold. Now, they weren't up a lot more like they should have been, but they were up more. But since their peaks, even though gold is only off 7% as of earlier today, Barrick Gold is 35% below its high. 35%. Newmont Mining is down 33%. These stocks are trading at less than 12 times earnings. So what does that tell you? About the sentiment. They're less than half of the market multiple. Hey, I'm having these technical difficulties. I was trying to text. So Paul, you got to let me know when to do the commercial break because you didn't give me a timer. So I have no idea how long I've been talking. So you got to send me a text and let me know when I need to break. I was hoping to do that without having to say it, but anyway, that's what I had to do. So where was I? Yeah, so the fact that these stocks are down so much shows you how negative the sentiment is in gold. But how negative the sentiment is in gold, that's how positive in everything else, right? Because it's the mirror image. You have crazy optimism on the overall stock market, ridiculous optimism in Bitcoin, but extreme bearishness, extreme pessimism in gold. Now, what investors don't understand, what the Fed doesn't understand.
Peter Schiff's analysis offers a sobering yet crucial perspective on the forces shaping our financial future. His insights into the systemic weaknesses of the current economic structure, combined with the enduring value of gold and silver, provide a roadmap for navigating the storm ahead. Let's delve deeper into why gold and silver are not just important but essential in today's economic context. Inflation remains one of the most pervasive threats to financial stability, and Schiff is clear about its devastating impact. While central banks and governments downplay its effects, the reality is stark. Inflation erodes purchasing power and disproportionately affects savers, retirees, and those on fixed incomes. The promise of a 2% inflation target, a mantra often repeated by the Federal Reserve, is increasingly unattainable, given the structural imbalances in the economy. Inflation acts as an invisible tax, slowly chipping away at the value of fiat currencies. Consider this: $100 in 1970 has the purchasing power of roughly $15 today. This steady decline underscores why gold and silver are invaluable. Unlike fiat currencies, whose supply can be manipulated at will by central banks, gold and silver possess intrinsic value that cannot be debased. They serve as time-tested hedges against inflation, preserving wealth across generations. The bond market, often referred to as the smart money in the financial world, is signaling deep concern. Rising yields on long-term treasuries reflect growing skepticism about the U.S. government's ability to manage its debt. Schiff emphasizes that this trend is not merely a technical aberration, but a reflection of deeper structural problems. The ballooning U.S. debt, now approaching $36 trillion, poses an existential threat to the economy. The servicing costs alone are set to consume an increasing share of federal revenues, leaving little room for essential expenditures. As foreign holders of U.S. debt, particularly China, continue to divest their treasury holdings, the bond market faces mounting pressure. This scenario is creating a feedback loop of rising yields, higher borrowing costs, and increasing deficits. Gold, in contrast, operates outside this fragile system. Its value is not tied to interest rates or the whims of central banks, making it a reliable store of wealth in uncertain times. One of the most significant developments in recent years is the trend of de-dollarization. Countries like China and Russia are actively working to reduce their reliance on the US dollar in international trade and finance. This shift is not just a political statement, but a strategic move to insulate their economies from the volatility and risks associated with the dollar-dominated system. China's aggressive gold accumulation is a case in point. Since the start of the Ukrainian conflict, China has reportedly purchased over 2,000 tons of gold while simultaneously reducing its U.S. Treasury holdings by $250 billion. This trend highlights a broader strategy, using gold to hedge against dollar devaluation and to lay the groundwork for a more resilient financial system. The implications for the dollar are profound. As more countries adopt similar strategies, the demand for dollars will decline, weakening its value. This erosion of trust in the dollar further underscores the need for individuals and institutions to diversify into gold and silver. Schiff often emphasizes the importance of gold as a reserve asset, a point underscored by its recent reclassification as a Tier 1 asset by the Bank for International Settlements, BIS. This move elevates gold to the same status as U.S. Treasuries, signaling its critical role in the global financial system. Central banks around the world are taking note. In 2023 alone, central banks purchased a record amount of gold, driven by concerns over inflation, geopolitical tensions, and the instability of fiat currencies. This unprecedented demand reflects a growing consensus. Gold is not just a relic of the past, but a cornerstone of the future. For individual investors, this trend offers a clear signal. As central banks continue to accumulate gold, its value is likely to rise. Investing in gold now provides an opportunity to align with this global shift and benefit from its increasing importance in the financial system. While gold often takes center stage, Schiff also highlights the unique potential of silver. Known as poor man's gold, silver offers a compelling investment opportunity due to its dual role as both a monetary and industrial metal. Silver's industrial applications are vast, spanning sectors like renewable energy, electronics, and healthcare. Its use in solar panels and electric vehicles positions it for substantial demand growth in the coming years. At the same time, silver's historical role as a monetary metal makes it a valuable hedge against currency devaluation. The gold-to-silver ratio, which currently hovers at historically high levels, underscores silver's relative undervaluation. This presents a unique opportunity for investors to capitalize on silver's potential for outsized gains as the ratio normalizes. In an era of financial uncertainty, Schiff strongly advocates for physical ownership of gold and silver. Unlike ETFs or futures contracts, physical metals provide true ownership and eliminate counterparty risk. Whether through coins, bars, or bullion, holding tangible assets ensures that investors are protected from the vulnerabilities of the financial system. This emphasis on physical ownership aligns with a broader trend among central banks and institutional investors, who are increasingly favoring tangible assets over paper claims. For individual investors, this is a timely reminder to prioritize security and stability in their investment decisions. The disconnect between gold prices and the performance of mining stocks presents a unique investment opportunity. Major players like Barrick Gold and Newmont Mining are trading at valuations that do not reflect the strength of the underlying metal. Schiff notes that mining stocks are trading at less than 12 times earnings, a glaring anomaly in a market where gold has risen significantly. This disparity is a reflection of extreme pessimism within the mining sector, which has created a contrarian buying opportunity for savvy investors. As traditional assets face mounting pressures, the flow of capital into undervalued sectors like mining is inevitable. Those who act early stand to benefit the most. Geopolitical tensions add another layer of complexity to the investment landscape. From the ongoing conflict in Ukraine to rising tensions in the Indo-Pacific region, the world is facing an unprecedented level of uncertainty. In such times, gold and silver serve as safe haven assets, providing stability in the face of volatility. Schiff emphasizes that these risks are not just abstract concerns, but real drivers of market behavior. As investors seek refuge from geopolitical instability, the demand for gold and silver is likely to surge, further supporting their prices. As we navigate the complexities of 2025, Schiff's insights offer a clear roadmap for investors. The challenges posed by inflation, rising debt, and geopolitical tensions underscore the importance of gold and silver as safe haven assets. By understanding the dynamics driving these markets, investors can position themselves to not only protect their wealth, but also capitalize on the opportunities ahead. Gold and silver are not just commodities, they are lifelines in a world of uncertainty. Whether through strategic acquisitions, physical ownership, or mining equities, the time to act is now. The road ahead may be turbulent, but for those who embrace the enduring value of gold and silver, the future holds immense promise.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.